People keep saying another 2008 is coming. No, it's not. And here's why. But you gotta stick with me, because one of the reasons it won't crash, the name of the engineer of the crash I'm dropping at the end, is gonna blow your mind. See, 2008 wasn't about people not paying their mortgages. Well, a portion of it was. It actually happened because the banks themselves collapsed. Rates weren't coming down, people weren't buying homes, and bonds, which are basically the IOUs the government sells to raise money, were tanking. Investors buy bonds when they trust the economy because it's safe and steady interest. Think of it like Uncle Sam borrowing 20 bucks and promising you back $21. But in 2008, nobody trusted the US report card. Auctions were weak, investors bailed, and rates continued to spike higher. So the feds panicked, and instead of letting the market correct itself, they said, fine, we'll do it ourselves. They bought up long-term debt, mortgage-backed securities, just to keep the system from imploding. Imagine a casino running out of chips and the house prints its own stacks just to keep the tables open. Well, that's what the feds were doing. Now let's talk about Bear Stearns. Bear wasn't a little mom and pop shop on the corner. They were one of the giants of Wall Street, trading stocks, bonds, mortgages, and everything in between. And in March of 2008, they collapsed almost overnight. 6 months later, the Lehman Brothers, another giant, fell in September. And that's when the housing market officially froze. But the rot had started a few years before. See, back in 2001, Bear Stearns bought into a little offshore company called Liquid Funding Ltd, based in the Bermudas. And Liquid Funding was basically a laundromat for bad mortgages. If the loan was toxic, say not paying, dragging down their books, Bear just shifted off to Liquid Funding. And those loans got chopped up, shuffled like 17 busted deck of cards, restacked, and sold back out as premium investments. That's what we in the business called collateralized mortgage obligations. It was pretty much trash dressed up as treasure. And every bank copied the play. JP Morgan, Wells Fargo, Citibank, they either led against or held those same repackaged loans because on paper, they looked safe. But what happened when the truth came out? Well, we all know how that story went. And the banks were left holding the bag. Credit froze, housing froze, and the Fed had to flood the market with printed bonds just to keep the lights on. Now here's the part almost nobody talks about. The little offshore company, Liquid Funding Ltd, it had a chairman, someone officially in charge of moving those toxic assets to keep the illusion alive and make sure Wall Street believed the garbage was gold. And that wasn't a faceless banker, it wasn't a politician. The guy sitting at the head of the table running the shell game that helped spark the 2008 crash, that man was Jeffrey Epstein.